Hey there, welcome back to the Investing Iguana. If you've been watching the markets this week, you've probably felt like you're on the wildest roller coaster of your life. Well, buckle up, because today we're breaking down the dramatic turnaround in Singapore's stock market that has investors breathing a massive sigh of relief. Just hours ago, Singapore stocks soared in a stunning relief rally after Trump announced a 90-day pause to his steep tariffs, temporarily lowering most rates to 10% during this period. The Straits Times Index shot up as much as 8.7% shortly after the market opened this morning, jumping nearly 300 points to reach 3,688. This comes after 8 straight days of losses, including Monday's brutal 7.5% plunge that marked the steepest single-day decline since the 2008 financial crisis. So what exactly happened? In what can only be described as a stunning reversal, Trump hit pause on the hefty duties he had just imposed on dozens of countries. The timing is interesting. This came less than 24 hours after these steep tariffs kicked in, following the most intense market volatility since the early days of COVID. Trump himself admitted, "I saw last night that people were getting a little queasy," and noted that the bond market right now is beautiful. Let's put this in context for Singapore investors. Our market has been on a wild ride lately. The STI, which had proudly crossed the 4,000 point mark for the first time on March 28th, quickly erased 7 months of gains, falling to levels we hadn't seen since September last year. At today's 30,600 level, we're still only back to where we were in November. The banking sector led today's recovery, with DBS jumping 10% to climb back above $40. OCBC hiked 10.3%, while UOB jumped 10.2%. Singtel was the most actively traded counter by volume, climbing 6.5%. But here's what matters for Singaporean investors. This pause is exactly that, a pause. The 90-day window gives countries time to negotiate with the US, but the underlying trade tensions haven't disappeared. Singapore's small open economy remains particularly vulnerable to any global trade slowdown. Our trade volume is more than 3 times our GDP, highlighting just how dependent we are on global flows. While Singapore faces the baseline 10% tariff, the lowest in Southeast Asia, we're still exposed to broader trade risks. If China and other Southeast Asian countries experience slower growth due to tariffs, Singapore will feel the pain. A lot of the supply chain, trade, and funding activities relating to these countries happen right here. The key sectors to watch are pharmaceuticals and semiconductors, which could face particular pressure if sector-specific tariffs come into play. Our manufacturing, trade, and logistics sectors have already been slowing down in early 2025. So what's the outlook from here? While today's rally is welcome news, Goldman Sachs still puts the probability of a U.S. recession at 45%, down from 65% before Trump's announcement. The tariffs still in place are likely to result in a 15% increase in the overall tariff rate. For Singaporean investors, this creates both challenges and opportunities. The STI offers some defensive characteristics that might be attractive in this uncertain environment. High dividend yields and relatively low volatility compared to other Asian markets. The index is also heavily weighted toward financials rather than technology, which could provide diversification from expensive global tech stocks. From a valuation perspective, the STI remains inexpensive relative to other Asia-Pacific markets, while its return on equity is relatively high, especially compared to its ASEAN peers. The next 90 days will be crucial. Malaysia is chairing a special ASEAN economic ministers meeting today to address the impact of U.S. tariffs on regional trade and coordinate a collective response. Singapore's trade minister has already indicated the country won't implement retaliatory tariffs, explaining that doing so would simply increase import costs. For Singaporean investors, the key takeaway is this: while we've gotten a reprieve, the underlying trade tensions remain. This is a good time to review your portfolio's exposure to export-dependent sectors and consider whether you're adequately diversified. The STI's defensive characteristics might serve investors well if volatility returns, and with Trump's unpredictable approach to trade policy, that seems almost certain. That's all for today's market update. If you found this analysis helpful, hit that like button and subscribe for more Singapore-focused financial insights. This is the Investing Iguana, helping you navigate the jungle of investing. See you in the next video.